Welcome back to the MCF Participant Series. My name is Hunter Nighbert, and I'm a financial advisor and retirement planning specialist with MCF. Today, we're going to look at the differences between pre-tax and Roth contributions in your employer savings plan. First, let's understand the basics. Both pre-tax and Roth 401k contributions offered in retirement savings plans are typically a part of an employee benefits package. The key difference lies in when you pay taxes on those contributions. One key distinction, and it's important to note up front, that there are income limitations with traditional deductible IRAs and Roth IRAs that do not apply in 401k. This also applies to the contribution limits as well. Roth 401k contributions are not the same limits as IRAs. It is subject to the individual contribution limits for group plans. For 2023, those under 50 years of age can save $22,500. If you're over the age of 50, you qualify for the catch-up contribution provision, which allows an additional $6,500 for a total of $30,000. With a pre-tax 401k contribution, the money is deducted from your paycheck before taxes are calculated. As a result, your taxable income is reduced, potentially lowering the amount of your income tax that you owe in the current year. Instead of paying taxes now, you pay taxes when you withdraw the money during retirement. This can be beneficial if you expect to be in a lower tax bracket during the retirement years compared to your current tax bracket that you're in today. Consider this if you are in your peak income years, or if you want to lower your taxable income, or if you think your effective tax rate will be lower in retirement. On the other hand, with a Roth 401k contribution, the money is deducted from your paycheck after taxes have been calculated. This means you pay the income tax on the money up front, but the contributions and any potential earnings can grow tax-free from then on. In contrast to pre-tax, a Roth 401k involves contributing money that has already been taxed. And since you've already paid those taxes up front, qualified withdrawals in retirement are generally tax-free. This can be advantageous if you anticipate being in a higher tax bracket during your retirement years, or if you want more tax-free growth potential. Consider Roth if you're young, number one, if you have a lot of years to invest, or if you just believe your tax rate will be higher at retirement. Roth savings in 401ks and IRAs do not have RMDs, or required minimum distributions, during the account owner's lifetime, allowing for greater flexibility in managing those withdrawals. Lastly, if legacy planning is a priority, Roth accounts can be very advantageous for passing wealth to heirs, since they are not subject to income tax upon inheritance. When does it make sense to stop a Roth contribution and/or change them back to pre-tax? Stopping Roth contributions can be a simple strategy to avoid moving to a higher effective tax bracket and/or rate. Or if you have a drop in income, pre-tax can save you money out of pocket because the upfront tax breaks that it provides. This hypothetical example shows an after-tax balance for someone who is 45 and puts $5,000 in a pre-tax and Roth 401k with a 7% return for 30 years and the same 28% marginal tax rate for each type. At the end of 30 years, the Roth has a higher balance by nearly $11,000. It's not too bad. Lastly, this isn't a zero-sum game, meaning that you can split your contributions and have both pre-tax and Roth contributions at the same time. If you contribute 10%, you could put 5% in pre-tax and 5% towards a Roth contribution with each pay period. It's also important to know if you get an employer match or a contribution from the employer, those dollars are always sourced as a pre-tax contribution. Having access to both pre-tax and Roth savings can create options to stay tax efficient in your retirement years when you're working on distribution planning. As always, we're here to help. Scan the QR code or enter the Calendly link into your URL to schedule a virtual one-on-one call today. Set up one if you have any questions on which contributions are best for you. And if you found this information useful, please feel free to share it with your coworkers, family, and friends. In the interest of time, that's all I have for today. Thanks for watching.